It's November 1923 in Weimar, Germany. A loaf of bread doesn't cost a few marks. It costs 100 billion, a lifetime of savings wiped out in months. Pensions, investments, the very concept of a future, turned to ash. This wasn't a random catastrophe. It was a pattern, a predictable mathematical cycle of boom and bust that has repeated throughout history. And this cycle, known as the 18-year cycle, has been triggered again. The last time it climaxed was 2008. We all remember the foreclosures, the bailouts, the financial terror. But what if 2008 was just the tremor before the real earthquake? The data is screaming that the final devastating phase of the cycle is not a matter of if, but when. And the math points to a single terrifying year, 2026. To understand what's coming, you must understand the echo. In the 1920s, Germany was crippled by war reparations, a debt so immense it could never be repaid through production alone. Their only escape was the printing press. They printed money to pay their debts, debasing their currency into oblivion. Now, look at the United States in 2025. The war reparations are gone, but they've been replaced by a new, inescapable burden. Entitlement spending, military budgets, and interest on the national debt. According to the Treasury Department's own data, the U.S. national debt is screaming past $35 trillion. This is not a political issue. It's a mathematical one. The tax revenue of the entire country can no longer cover the promises made. So, just like Weimar Germany, America is facing the same fateful choice. Default on its obligations, or print the currency into worthlessness. History shows us there is no third option. This brings us to the engine of the crisis, the 18-year real estate cycle. It was first documented by economist Fred Harrison, who predicted the 2008 crash years in advance. The cycle has two main phases. First, about 14 years of growth, where real estate values slowly, then rapidly increase. This is fueled by cheap credit and a belief that prices can only go up. Then comes the final phase, a 2-year frenzy of speculation, the winner's curse, where the last buyers pay irrational prices just before the peak. This peak is inevitably followed by a brutal 4-year crash. 2008 was the last peak. At 18 years, you land squarely in 2026. But this time, the mechanism has a new, dangerous accelerant. Tariffs and trade wars. When nations impose tariffs, goods become more expensive. This is inflation. Other countries retaliate with their own tariffs, hurting your exports and slowing the economy. To combat this slowdown, what does the government do? It spends money it doesn't have. Stimulus checks, subsidies, bailouts. And who finances this spending? The central bank, the Federal Reserve. The Fed prints money, or more accurately, creates digital currency to buy government debt. This new money floods the system, but it doesn't go to the average person. It goes to the banks. And what do banks do with cheap, nearly free money? They lend it out against hard assets, the safest of which has always been real estate. This creates the final bubble, an everything bubble with real estate at its core. The villain isn't a single person. It's a system designed to concentrate wealth by privatizing profits and socializing losses. A system that is now reaching its mathematical breaking point. Let's move from theory to the terrifying reality of the numbers. The data for 2024 and 2025 isn't just a red flag. It's a screaming siren. Start with commercial real estate, the canary in the coal mine. According to the Mortgage Bankers Association, MBA, nearly $1 trillion in commercial real estate debt is coming due in 2024 alone. But office vacancy rates in cities like New York and San Francisco are at record highs, over 20%. These buildings are worth a fraction of what they were, but the loans are based on the old inflated values. This is a slow-motion default that will vaporize regional banks. Now look at the residential market. The Housing Affordability Index is the worst it has been in modern history. The retail buyer is gone, so who is buying? Institutional investors, BlackRock, Blackstone, and others. They aren't buying homes for families to live in. They are buying revenue streams, turning the American dream of homeownership into a permanent rental society. Now for the shadow statistics. The government claims inflation is around 3%. But if you calculate it the way it was calculated in the 1980s, the real number is closer to 10%. The Bank for International Settlements, the central bank for central banks, warned in their 2024 report about the unprecedented levels of global debt and the illusion of stability. They know the system is at its limit. From the booming, now stalling markets of Austin, Texas, to the deceptively quiet Rust Belt. And in places like Florida, an external shock is accelerating the crisis. Extreme weather is making entire areas uninsurable, rendering mortgages worthless and property values catastrophic. This isn't one problem. It's a dozen failures, all cascading at the exact same time, right on schedule. So what does the climax look like? The trigger will likely be the commercial property collapse. When that trillion-dollar debt bomb detonates in late 2025 or early 2026, the regional banks that hold those loans will fail. This will trigger a credit freeze. No loans for cars, no loans for businesses, and critically, no new mortgages. Without new buyers, the artificially high housing market will seize up. The institutional investors, like BlackRock, won't be there to save it. Their business model is cash flow. They will sell properties to maintain liquidity, adding to the downward pressure. This is when the panic selling begins. The government and the Fed will have no choice but to respond with the only tool they have left. A bailout so massive it will dwarf 2008. Trillions in newly created currency to paper over the losses. This is the hyperinflationary event. It's a desperate final attempt to save the debt system by sacrificing the currency itself. Your dollars in the bank, your 401k, your pension, their purchasing power will be decimated. The 18-year cycle doesn't end in a simple recession. It ends in a currency reset. This is not a prophecy of doom. It is a warning based on a historical pattern as reliable as the seasons. Knowing the pattern is the first step to defending yourself against it. The world will not end, but the financial system as we know it will be fundamentally altered. So, how do you prepare? First, become hostile to debt. In a hyperinflationary crisis, debt is a trap that becomes impossible to escape. Second, understand the difference between currency and money. Currency is what the government prints. Real money holds its value across centuries. Third, invest in tangible assets and skills that cannot be printed. Land, productive businesses, and your own abilities are the ultimate stores of value. The coming years will be a test. For those who are unprepared, it will be a catastrophe. But for those who understand the cycle, it represents the greatest transfer of wealth in human history. The pattern is set. The data is clear. The clock is ticking towards 2026. The choice of what you do next is yours.